Our classroom stock portfolio of high-yield, dividend-paying companies now has an annual return of 34.37%, and it's beating the S&P 500 since the portfolio started. And our dividend-growth stock portfolio has an annual return of 21.2%. It too is beating the S&P 500. And surprisingly, our high-yield portfolio increased its performance lead over our dividend-growth portfolio, which still surprises me. And like in last week's video, later in this video I'll discuss ways to potentially boost the return of our stock portfolios, but it will require giving up some portfolio diversification. Now on Friday, the non-farms job report came out, and it showed incredible job growth in September, including an upward revision on a previous jobs report. This sent the S&P 500 up 0.9% on Friday. Some Wall Street commentators who see the negative in everything worried that the Federal Reserve's double rate cut meant the Fed thought something was seriously wrong with the economy. But Friday's jobs report definitely tamped down that concern. So what is this slide showing? It's showing the portfolio value over time for our main portfolio, which invests almost exclusively in dividend growth stocks. In 2022, we started investing $12.50 each week into the portfolio for a classroom project, and it's now worth $2,492.56 after 144 weeks. A new high for the portfolio. Each week we take that $12.50 deposit and split it up to buy 10 different dividend-paying stocks, so that's about $1.25 per stock. And in August of last year, we started a second portfolio, this time investing in high-yield dividend-paying stocks. The tan line on the chart shows what the portfolio value would be if we had instead put the money into a savings account. In our first year, 2022, stocks did not do well, and as you can see, our portfolio had overall losses where the blue line falls below the tan savings line. But the power of compounding is working in our favor as the portfolio really took off in November of 2023. I'll also update our tech stock portfolio later in this video, which has only existed since April of this year, but has been the best performing portfolio over that time, although with a lot of volatility. And for those who have been asking, I put the dividend growth stock portfolio and the high yield stock portfolio on our website, which is beatthestockmarket.com. More on that on the next slide. Hi, Professor Rex here. If you're new to my channel, I teach college accounting, and I often show my students how to use the accounting concepts that I teach to pick stocks, because it grabs the attention of my students and gets them engaged. To show them accounting concepts in action, starting in 2022, each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 a month, into 10 different dividend-paying stocks. And the stock list changes each week. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings goals and get ideas of company names that they can do their own research on. There are timestamp links in the description of the video in case you just want to jump to the list of stocks we bought this week, or the list of our best performers, or any other section of the video. In 2022, the year we started the dividend growth portfolio, the market did not perform well. Bonds also did not do well at all. But because I don't believe in trying to time the market, we kept buying each week at what turned out to be great prices. Then in 2023, stocks took off. Currently, the portfolio's value is over $2,492. The portfolio's return has been 21.2%. Last year, the portfolio's return was 28.6%, which beat the S&P 500. And in the preceding year, the portfolio once again beat the market. For those that have requested it, I've now put the dividend growth stock portfolio on my website, beatthestockmarket.com, as well as the high yield portfolio. And because the high yield stock portfolio currently lacks any technology stocks, I've added to my site a list of technology focused investments that provide income with yields from less than 2%, like Microsoft, one of my favorite companies, to yields as high as 10 to 12%, all of which I either currently invest in or have invested in. I'll also tell you which is my favorite. Of course, the technology focused investments with the higher yields do not have the chance to grow their distribution yields as fast as a company like Microsoft or Broadcom. There's always a trade-off. For those that can't afford a subscription, I'll continue doing these weekly videos on the weekend, showing what I bought on the previous Monday. Subscribers will have real-time access to the list of stocks we buy each Monday, as well as real-time notifications when we sell a stock. Subscribers will also get a detailed report of portfolio holdings, and they will get access to the complete history of our trade confirmations as we're gradually putting them up on the website. Oops, I forgot to click that so you can see where the technology investments that provide income are. All right. In this video, we talk a lot about our dividend growth portfolio and our newer high yield portfolio, which is geared more towards those nearing retirement. The table at the bottom of this slide shows a portfolio comparison when both portfolios existed, because remember, they were started at different times. The high yield portfolio was started in August of 2023, and the annualized return so far is 34.37%, which is surprisingly higher than our dividend growth portfolio, which has an annualized return of 24.08% over the same time period. I would expect that the dividend growth portfolio would have the higher return over the long run, especially since the high yield portfolio has 0 tech stocks so far, but time will tell. If an investor was solely investing in high yield in the high yield portfolio, I would think about supplementing it with some tech stocks for additional diversification. On our website, we have ideas, as mentioned on the previous slide, for technology-focused investments that provide income. Now remember, the high yield portfolio has only existed for 14 months, so its annualized return will likely jump up or down to a greater extent than the return for our dividend growth portfolio. This slide shows the cumulative growth of the dividends we have received in our dividend growth stock portfolio. Our dividends for the latest quarter, which just ended, increased 39% over the previous quarter, and our dividends for this latest quarter increased 130% over the same quarter a year ago. The graph shows how quickly the dividends are growing and is a great example of the power of compounding. Albert Einstein is widely rumored to have called compound growth the most powerful force in the universe. So why do we invest only in dividend-paying stocks in our 2 main portfolios? The first reason we stick with dividend-paying stocks for our dividend strategies is, according to Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, average return has been much lower at 4.27%. The study is updated each year, so go check out the source link that I include at the bottom of the screen. Morningstar also recently released a report that went all the way back to 1927 and came up with the same conclusion. Dividend-paying stocks have both a higher return and less volatility than non-dividend paying stocks. That second point about having less volatility is probably even more important than the fact that dividend-paying stocks have a higher return. So why is a lower amount of volatility so important? Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile on average? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolios only invest in dividend-paying stocks that have increased their dividends recently. BlackRock recently released a report showing that $10,000 invested in companies that grow their dividends, in other words, increase their dividends, or companies that initiated dividends, in other words, they started paying a dividend for the first time, grew to $2.6 million versus $1.6 million for the S&P 500, a difference of 62.5%. That same $10,000 invested into non-dividend paying stocks only grew to $1.2 million. So, in other words, stocks that raised their dividends or started paying a dividend beat the stocks that did not pay a dividends by 116.7%. Now, the holy grail of dividend investing is having a stock portfolio that produces 2 things. A growing stream of income that produces enough income to cover your expenses plus extra cash to cover travel, vacations, luxury purchases, etc. And 2, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. So here are 2 examples of stocks growing their dividend payouts over the years. The first stock is Broadcom. Now, I bought Broadcom, which is a chip maker, in 2020, just 4 years ago, for my taxable account. At the time, its yield was 5.01%, meaning for every $100 I invested in the stock, I would receive $5.01 per year. The company has quickly grown their dividend to the point where that yield now, based on the original investment, is 8.21%. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividends well into the future. And if not, that's why we have constructed a diversified portfolio. This is the power of investing in a quality dividend growth company. My second example of a high quality company with a history of raising its dividends is Home Depot. In 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter that I had started at the time. And Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I had invested in the stock, I would receive only 83 cents. Seemingly not much to get excited about, right? But over the years, Home Depot has grown the dividend to the point where the yield, based on my original investment, is now 31.1%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, this is why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly will not find a bond that pays anywhere close to the yields on the original investment that these two stocks are paying. And bonds do not increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $123,250 of tax-free income each year if you're married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses but grows over time. And if you're married and filing jointly, you can make up to $123,250 in qualified dividend income and pay zero federal tax on those dividends if you have no other income. It's perfect for retirees. If you're single, the dollar amount is $61,625. Those amounts often increase each year as the standard deduction increases and the tax brackets are adjusted. So how are those amounts calculated? First, you find the 0% tax bracket for long-term capital gains, and then find the standard deduction, which can be located in IRS Publication 505. As you can see in 2024, the standard deduction increased, meaning that you can potentially earn even more tax-free income from qualified dividends. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $123,250 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why do we choose to start investing in our model stock portfolio with only $12.50 per week, which is essentially the same as $25 per paycheck? I personally am investing a lot more than these in these dividend strategies, but for our classroom model portfolios, the main reason we started with a low weekly investment amount is because I wanted to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with very little money. Originally, I invested $25 per paycheck into this dividend growth portfolio, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation and replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, like I said, I also invest in these same stocks in my retirement and my taxable brokerage account. The research we discuss in class is the same research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of the original $11.74. For our classroom dividend growth stock portfolio, in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. Now, a very popular exchange-traded fund that only holds dividend stocks is called the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our 2 dividend stock portfolios. As of today, our dividend growth classroom stock portfolio's annual return is 21.2%. If we'd instead invested the same exact amounts into the ETF called SCHD on the same days, the portfolio's return would only be 12.3%, a difference of 8.9% per year. Our high yield portfolio is also outperforming SCHD, but by an even larger margin. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our 2 dividend-paying classroom stock portfolios. I also prefer our actively managed classroom stock portfolio strategy rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. SCHD has had, at times, had large positions in stocks that I consider to be value traps. This slide shows our best performing stocks in our dividend growth stock portfolio based on when they were initially purchased. Broadcom, a chip maker, and Evercore, an investment bank, both remain at the top. Both have total returns over 200%, which means the investment has tripled. So far, those 2 stocks have tripled and 4 stocks have doubled their initial investment, with ITT just missing the list with a 97.4% return in less than 2 years. Goldman Sachs also makes the list this week with a 66.8% total return on its initial investment in less than a year and a half, or I guess it's a little bit more than a year and a half. Stocks in yellow, which is F&G annuities and ReposiTrak, have been sold. Those 2 happen to be under the radar dividend payers. And remember that the total return includes both the dividends the company has paid as well as increase in the stock price. Now let's talk about the strategy column, specifically the category called dividend growth stocks. 90% or so of our investments made in this portfolio were made in these stocks, which means they are high quality stocks with a great track record of increasing the dividend payouts to investors. The other 10% of the investments so far have been invested in usually smaller, under the radar companies that have recently started paying a dividend, like F&G annuities in yellow and ReposiTrak in yellow. These under the radar dividend paying stocks tend to be riskier because they are usually smaller companies, but studies have shown they historically beat the market averages by a significant amount. This slide shows our best performing dividend stocks this week for our dividend growth portfolio. It does not include dividends. The best performers were EOG Resources, Build-A-Bear, Albemarle, Bristol-Myers, Meta Platforms, Hess, Salesforce, Lockheed, and Ameriprise. This slide shows our best performing dividend stocks this week for our high yield stock portfolio, which has far fewer holdings than our dividend growth portfolio. The best performers were EOG Resources again, Kinder Morgan, Bristol-Myers, and CVS. And this slide shows our best performing tech stocks this week. And the best performers were ticker symbol Team, ServiceNow, Shopify, and Salesforce. Before we look at the 10 stocks we bought this week for our dividend growth portfolio, here are the dividend paying stocks we bought a year ago along with their total returns, which of course does include dividends. On the left are the 10 dividend growth stocks we bought about a year ago. Stocks in yellow, which is Fidelity National Information Services, has been sold. American Express has been the best performer with an 87% total return in a year, and Dollar General has been the only clunker. The average return of the 10 dividend growth stocks we bought a year ago is 36.14%, with Fidelity National only being held for half a year. On the right side of the slide are the 7 stocks we made for our high yield stock portfolio. Usually we make 8 purchases, but a year ago we only made 7. That portfolio utilizes 2 different strategies, and the strategies often overlap, meaning we often make 2 purchases of the same stock. The average return over the high yield stock purchases we bought a year ago is 38.34%, despite 2 of the purchases not being held for the full year. The annualized return for our high yield purchases a year ago was 46.29%. Obviously, our purchases will not continue that high rate of return, but so far the portfolio is off to a great start. Here's the usual disclaimer. This presentation is for informational purposes only. It is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own research. Now let's talk about the dividend-growth stocks we bought last Monday. Here are my ratings for the top 15, but remember we only buy 10 per week. We purchased the first 10 stocks on the list that are not in yellow, and this week we don't have any in yellow. Stocks in yellow have already grown to be 4% or more of the portfolio, but again, we didn't have any of those stocks this week. A brand new position we started this week was drug maker Merck. The company has a 2.7% yield when we bought it on Monday and has earned a quality rating of A. Only 4 stocks on this list have a better quality rating. Remember, each week we buy 10 stocks, and since we're investing such a small amount each week, it means we are buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends in the same stock from which the dividend was paid. Instead, each week when we're buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total, and if we had sold a stock, we add that to it, and split it amongst the 10 stocks that we were purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks we are purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on your broker's auto reinvest feature, but I think it's more ideal to reinvest in our top stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. This table on this slide shows a company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. The most undervalued stocks last week appeared to be ASML, Qualcomm, and Constellation Brands. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates they are likely to continue to raise dividends. Therefore, this is a dividend growth strategy. Stocks with the highest yields were, in order, Bristol-Myers, Chevron, HF Sinclair, and PNC Financial. Now remember, this dividend growth stock portfolio is in a brokerage account separate from my regular brokerage accounts to make tracking this portfolio easier. So in my other brokerage accounts, I'm also investing in these dividend growth stocks and the high yield stocks in the next few slides. This week I purchased over $2,900 of these stocks as I reinvest dividends and gradually transfer out of my main dividend ETF and buy these stocks instead. I'm also trying to tweak the buying strategy a bit to see if I can boost returns. And so far the results have been good. And when I get enough data, I will share more of that with you. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. The other 10% so far have been invested in smaller, under-the-radar companies that have recently started paying a dividend. Those under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, on average, but studies have shown they historically beat the market averages by a significant amount. All the stocks we bought this week qualify as high quality and are dividend growth stocks, which means they have a history of substantially raising the dividends that they pay to their shareholders. Risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantage the company has, the better investment candidates they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making. But also our research dives deep into accounting data to look for red flags in the company's accounting practices as well as the quality or reliability of their reported profits. And finally, the last quality component is financial health. If you're looking for lower risk stocks, I would suggest looking at Microsoft, Nike, Huntington, Broadridge, and Yum Brands. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. The companies earning the highest financial health ratings are Microsoft and Broadridge. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Bristol-Myers, Lamb Weston, Chevron, PNC Financial, and Broadridge. All these earned an A- or better grade. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade called Dividend Growth Potential, the companies in the best position to increase their dividends substantially are Bristol-Myers and McKesson. These earned A- or better grades. The companies with the best combination of recent dividend increases, current yield, and potential for future dividend increases are Bristol-Myers and McKesson. Here are our trade confirmations from last Wednesday for the dividend growth stock portfolio. We took the weekly deposit plus any dividends that have recently been received and then reinvested them in the top 10 stocks in our buy list for the week, as long as they don't have a portfolio allocation of 4% or greater. Now let's talk about ways to potentially increase the return of our dividend growth portfolio. For those that are okay with giving up some portfolio diversification, I believe there are 4 potential ways to boost the portfolio's return. Each week we buy 10 different dividend-paying stocks ranked 1 through 10. On average, the stocks in position 1 through 5 outperform the stocks in positions 6 through 10. Therefore, the first way to potentially boost portfolio returns is to buy only the stocks in positions 1 through 5. However, the downside is this reduces portfolio diversification, but some investors are comfortable with a more concentrated portfolio. Option number 2, don't limit individual portfolio holdings to 4% of the portfolio's total value. Normally, if a stock's allocation in the portfolio is 4% or greater, I will not purchase more of that stock. This technique reduces the portfolio's risk by ensuring the portfolio does not become heavily weighted in 1 or 2 stocks. I purposely created this portfolio so it would be very well diversified, because the ultimate goal of dividend investing is to have the dividends cover all your expenses plus generate extra income for vacations, travel, etc. I am a conservative investor and I'm personally investing in a lot in these dividend portfolios. So I want to make sure the portfolio is not only well diversified between sectors, but also between industries and even sub-industries. That way, when the inevitable dividend cut happens, it doesn't affect one's cash flow in a major way. However, an investor who has a higher risk tolerance and therefore doesn't mind a more concentrated portfolio might try removing the 4% limit in an attempt to boost the portfolio's returns, especially if the company is in the top 5 of that week's rankings, as mentioned in bullet point 1. Number 3, the under-the-radar dividend payers, despite having some incredible performers like F&G Annuities' 119% return in 12 months, and Repositrax's 97% return in the same time frame, they on average have not performed quite as well yet as the dividend growers in the portfolio. So skipping the under-the-radar dividend payers is an option to try to boost portfolio returns. One possible reason these stocks haven't done quite as well as the dividend growers is because many of the under-the-radar dividend stocks are very small companies, and small stocks have not performed as well in recent years. Like the previous strategy, this method reduces portfolio diversification. And number 4, potentially sell when a stock is fairly valued, even if the dividend quality metrics are excellent. Now, we don't sell often in the portfolio, definitely not weekly, and tend to only sell if the company cuts the dividend or the stock appears to be overvalued, or the company's dividend quality metrics fall out of the top 50%. In other words, if a stock appears to be fairly valued, but the dividend quality metrics are still good, we usually will not sell the stock just because it's fairly valued. But if you have your own valuation method and it signals that the stock is fairly valued or even overvalued, you might try selling the stock at that time and reinvesting that week's top 10 stocks that we are buying. The downside would be higher turnover, but this could boost your portfolio's return by not holding on to fairly valued stocks. If you try this, I'd be very interested to hear your results. Of course, the 4th strategy is the most difficult to implement because you have to implement your own valuation methodology. For those looking for a less hands-on approach, let's talk about some options to potentially simplify things. For model portfolios, we invest weekly, but there's no hard and set rule that says to do that. Most people invest with every paycheck, in other words, every 2 weeks, meaning that most people have funds taken out of their paycheck, which is usually every other week, and it's automatically invested in their 401k. When I started our Dividend-Growth stock portfolio, I originally invested $25 every other week instead of $12.50 every week. I only switched from every other week to weekly because I found the process to be fun. The advantage of investing every week as opposed to every other week or monthly is you get more diversification. So if one doesn't mind less diversification in the portfolio, option 1 is to invest every other week or even monthly instead of weekly. That could simplify things. Option 2 is to just buy the high quality stocks, meaning those with a quality rating of B- or better, and hold forever. Over time, some of them will turn out to be clunkers, but they will just be very small parts of your portfolio as you let your winners run. On this slide, we're looking at stocks that have raised their dividends recently. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher's salary. Historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. Now this week, Lockheed Martin announced they're going to be increasing the dividend by 4.8%. Also, it turns out I missed PNC Financial increasing their dividend back in July, so I added their dividend increase to this slide. We should start seeing more dividend or even more dividend increases as companies will start announcing their third quarter results later this week. I think PepsiCo starts on Thursday, and then the big banks like JP Morgan and Bank of America and Wells Fargo will announce their quarterly reports on Friday. The last 22 dividend increases for the portfolio have an average increase of 10.2%. This slide shows stocks in our portfolios that have chosen to split their stocks. Since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and the dividends per share that we received once a stock split has occurred. And check your results as Lamb Research did a 10-for-1 stock split last week. So you should see 10 times the shares, and the price will be much more affordable. Here's a look at the 10 stocks that make up the largest portion of our dividend growth portfolio as of Sunday. Currently, 3 stocks comprise 4% or more of the portfolio, with Allegion still leading the way. EOG Resources is new to the list as energy stocks rose this week on Middle East unrest. Remember, our goal is to build a conservative and diversified portfolio. By limiting this amount, we invest into one single company. Aggressive investors might not want to limit the investment into any one stock. But, as mentioned earlier, I'm a conservative investor, therefore we temporarily stop investing in a company if they make up 4% of our portfolio. This leads to a less risky, more diversified portfolio. In other words, if on Monday Allegion, American Express, or MasterCard make our buy list, we will not buy them because they're at 4% or more. It's true that our portfolio's returns would likely be higher if we always invest in our top 10 stocks, regardless of the size of the stock portfolio allocation, but that also creates a more concentrated, more volatile portfolio, and many investors can't psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the wrong time. Our portfolio holdings are now at 99. They're up 1 from last week because we bought Merck. That might seem like a large number of companies to keep track of, but the spreadsheet we've developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information in the spreadsheet, which we do at least weekly and doesn't take that much time. However, it did take us a long time to develop the spreadsheet. It took us over 2 years of hard work and experimentation. Now let's talk about our high-yield dividend-paying stock portfolio. I've had several older students who are closer to retirement take my classes. They are more interested in stocks with a higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of last year, we started investing $12.50 each week into a separate portfolio, but they're for stocks with a higher payouts. The portfolio as a whole has an annual return so far of 34.37% in a little over a year. Since the portfolio has been in existence for 14 months, that return will likely fluctuate a lot more than the return of our dividend growth stock portfolio, which has existed for well over 2 years. Currently, the high yield portfolio's dividend yield is 4.15% if you bought everything today, but the companies in it likely will not grow their dividends as much as the stocks in your dividend growth stock portfolio. Therefore, this portfolio would be more geared towards investors closer to retirement. Having said that, many stocks in the portfolio have increased their dividends, pushing the portfolio's yield based on the amount we've invested to 4.96%. Now, 2 strategies are being implemented in this portfolio, as you'll see in the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features stocks paying higher dividend yields, but places a bit more emphasis on recent dividend growth than Strategy 1 in an attempt to try to get the best of both worlds, that being high yield and dividend growth. So far, Strategy 2 has been the better performer. The average investment in Strategy 2 has provided a total return of 18.18% and has been held for an average of 176.8 days so far, which is an annualized return of 41.22% using Excel's rate function. Now, obviously, it's not likely that the portfolio can keep up an annualized return that high since stocks historically average 9 to 10%. On this slide, we're looking at the high-yield, dividend-paying stocks we bought this week. And because the high-yield stock portfolio currently lacks any technology stocks, for those that want to add diversification to the portfolio, I added a list to my site of technology-focused investments that provide income with yields from less than 2%, like Microsoft, to yields as high as 10 to 12%, all of which I either currently invest in or have invested in. I'll also tell you which is my favorite. Of course, the technology-focused investments with the higher yields don't have the chance to grow their distribution yields as fast as a tech stock like Microsoft or Broadcom. There's always a trade-off. Now, back to this high-yield dividend-paying stocks we bought. One thing that's different about this higher yield strategy versus our dividend growth strategy on the previous slides is we only purchase 8 stocks, and we have 2 different strategies within this portfolio. As mentioned before, Strategy 1 emphasizes a high dividend yield over dividend growth. It's perfect for investors in retirement or getting close to retirement. Strategy 2 still emphasizes high dividend yield, but also places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are 2 different strategies, we have 4 stocks in Strategy 1 and 4 stocks in Strategy 2, giving us 2 rankings. So each week we take $12.50 and split it between the 8 stocks. So each stock gets a 1/8 weighting. Having 2 strategies within one portfolio also means that a stock could appear in both Strategy 1 and Strategy 2, which has been occurring a lot recently. If that's the case, instead of the stock getting a 1/8 weighting, they get 2/8, which is 1/4, which is equivalent to 25% of that week's investment. Both strategies still only invest in high-quality stocks, meaning a quality rating of B- or better. The 4 high-yield stocks we bought this week while implementing Strategy 1 are Bristol-Myers, Chevron, Enterprise Products, and PNC Financial. And the 4 high-yield stocks we bought this week while implementing Strategy 2 are Bristol-Myers, Chevron, PNC Financial, and HF Sinclair. This week's purchases have an average yield of 4.6%, I should say last week's purchases, with Enterprise Products coming in the highest with a 7.2% dividend yield. Here's a look at last Monday's ratings for competitive advantage, management, and financial health. And on this slide, we can see Monday's grades for recent dividend growth and current yield, as well as recent dividend growth history. In the last column, you can see their grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consists of stocks with usually lower yields but a greater potential for excellent future growth in those dividend payouts. And here are trade confirmations from last Monday for the high yield stock portfolio. We took the weekly deposit plus any dividends that we had recently received and then invested the total in the 8 stocks on our buy list for the week. Now let's talk about our 2 technology stock portfolios. Because my students love technology stocks as well as crypto and options, we started 2 technology portfolios just for fun. For the first one, on January 1st of this year, I funded a Fidelity account with $1,000 and we invested it into only stocks offering products or services involved with certain technology themes. Unlike our other portfolios, we're not investing additional funds each week into this portfolio. We're sticking with the original $1,000 investment. The tech themes we built the portfolio around so far are artificial intelligence, cloud computing, software as a service, cybersecurity, and big data. This portfolio can invest in sectors outside of the technology sector as long as the company is connected to one or more of our tech themes. For example, both Meta Platforms and Google are in the portfolio, but are both in the communications sector, not the technology sector. So far, the portfolio has increased 26.7% in a little over 9 months. In comparison, technology ETF, or the technology ETF with the ticker symbol XLK, is up 17.7% over the same time period. Best performers so far are NVIDIA at 159%, Meta Platforms 74%, Broadcom 64%, SAP, Pure Storage, IBM, and Fortinet. And back in late April, we started another technology portfolio, but this one only invests in stocks that are officially in the technology sector. Like the other portfolios, we invest $12.50 each week into it in the first year and then boost that investment annually by the rate of inflation. Now, I hesitate to call this a portfolio since it's limited to only one sector, but so far it's been very fun to follow. Since this portfolio has started, it has outperformed the two dividend portfolios over the same time period, but that's a short time since this was started on April 29th of this year, and its volatility has been pretty high. So how is this portfolio different from the $1,000 tech portfolio on the previous slide? The portfolio on the previous slide is based on certain technology themes and therefore includes some stocks that are not technically in the technology sector, like Google and Amazon and Meta. So on this slide, I rate the top sectors for the week, but they must be in the technology sector. The average investment so far has been held for 80.3 days and has produced an average total return of 8.35% using Excel's rate function. That's a 43.95% annualized return. If we'd instead invested our weekly investment into the ETF with the symbol XLK, instead of an 8.35% average, we would have an average return of 3.7% with the same average holding period. Note that all these stocks are higher quality, meaning they must have a quality ranking of B- or better. Also note that the ranking system used for these tech stocks may differ from the rankings we use to rate dividend growth stocks, because many stocks do not pay dividends. Therefore, in this ranking, we ignore the criteria that involves a dividend stuff like dividend growth, dividend payout ratio, etc. But we use the valuation methodologies we discuss in class that we use on all large stocks, whether they pay a dividend or not. So our top 4 tech stocks for last week were Adobe, ASML, Microsoft, and NICE. So in the comments, let me know if you have any questions, and also let me know what other kind of investing videos you'd like to see. And finally, here are the places you can reach me. YouTube, obviously, as well as my website, beatthestockmarket.com, LinkedIn, and Twitter. And remember, you can now find the dividend growth stock portfolio and the high yield stock portfolio on beatthestockmarket.com with real-time transaction data on Mondays when we make our weekly investments and anytime we sell a stock, as well as information about the portfolio holdings. I'll see you again next week with a list of stocks we will have purchased on Monday. See ya!